It's currently at $88.44 a share, and Yahoo analysts estimate it can go up to $153.57 in the next 12 months. If it does, that will be a 73.64% increase. Hey guys, today we're going to be going through the stock analysis for e.l.f. Beauty Inc. And this stock has an earnings report dropping on February 6th, which is a couple of days from now. In any event, we know an earnings report is sort of like going to a casino. An earnings report is like, as a kid, you'd have a report card in school to tell you how you did over the last semester. Well, businesses have an earnings report to say how they did over the last quarter. And if you're holding that stock and the earnings report comes out good, the stock price can dramatically jump. And if it comes out bad, the stock price can dramatically drop. So keep that in mind when considering buying a stock before the earnings report comes out. In any event, this stock has been dropping for the last 3 weeks, even though each week the drop has gotten smaller. It's currently at $88.44 a share, and Yahoo analysts estimate it can go up to $153.57 in the next 12 months. If it does, that will be a 73.64% increase. Now, having said that, let's jump over into our StockSage app and take a look at the fundamentals for e.l.f. Beauty. And we are in the StockSage app, the app which goes through the 52-week low of the stock market every day and pulls up the stocks that are down there, which are fundamentally sound. And you can determine their soundness even more by using these filters: the stock buybacks, the current assets, profit margin, and dividend yield. But for now, we're just going to scroll down to e.l.f. Beauty and click on the ticker symbol. And we see that e.l.f. Beauty, together with its subsidiaries, provides cosmetic and skincare products under the e.l.f. Cosmetics, e.l.f. Skin, and so on. Gives the description up here at the top. Now, if we look at this stock, we know one of the first things we like to see with a stock is we like to look at the earnings per share. And we like to see the earnings per share preferably increasing every year and positive numbers. That's why in StockSage you see the earnings per share for the last 5 years for all these stocks right on the front screen. In any event, in 2020, which was a COVID lockdown year, a lot of companies lost money that year, but their earnings per share was 37 cents. 2021, it dropped 13 cents. 2022, it increased again, 43 cents. 2023 $1.17, 2024 $2.33, and now in 2025. Now this is a projection because we're just in the first month of the year. Well, actually, we just crossed into the second month of the year. But so this is a projection, but it's projected at $1.85 so far. That could change. Now, if we look at the high and low prices for these years, in 2020, the stock was at $7.58 at its low, $26.19 at its high. That was a 245.51% increase. In 2021, it was at $21.15 at its low, $33.38 at its high. That was a 57.83% increase. In 2022, it was at $20.49 at its low, $56.92 at its high. That was a 177.82% increase. 2023, it was at $48.10 at its low, $153.53 at its high. That was a 219.19% increase. And in 2024, it was at $98.50 at its low, $221.83 at its high. That was a 125.21% increase. So the increases we're getting from year to year are pretty decent. Of the last 5 years, it's only been under 100% once. That was in 2021. And if we look at the projection for this year, the stock is currently at $88.44. Yahoo analysts estimate that it can go up to $155.82. That will be a 76.19% increase if that happens. Now, we know that you cannot look at the low price of a stock to determine how low it can move and when it can move back up. But something that's more predictable is the low PE ratios. When we look at the low PE ratios, we can get an idea of where stock is going to stop. And in 2020, the low PE ratio was down to 20.56. But this is an in-demand stock. So the low PE ratios are generally pretty high. In 21, it was 167.58. In 22, it was 47.95. 23, 41.02. And 24, 42.24. So with the exception of the COVID lockdown year, 23 was the lowest P ratio at 41.02. And right now it's at 47.81, which is lower than where it dropped in 22, which was 47.95. So if we're not at the bottom for this stock, we can be pretty close. So we can look at our candlestick chart see when it starts to move back up and jump in, and we'll probably be right on it. In any event, let's look at our fundamentals for this stock. In 2020, COVID lockdown year, a lot of companies lost money that year because a lot of businesses had to close. But they made money. They suffered more the next year, but they made money that year. In 2020, they made $282,851,000 in sales and revenue. After paying all expenses, they retained 17,884,000 in profit. That was a 6.32% profit margin. In 2021, they made 318,110,000. After paying all expenses, they retained 6,232,000. That was a 1.96% profit margin, a drop that year. But in 2022, they made 392,155,000. After paying all expenses, they retained 21,770,000. That was a 5.55% profit margin. And notice that their sales are growing every year. In 2023, they made 578,844,000. After paying all expenses, they retained 61,530,000. That was a 10.63% profit margin. And lastly, in 2024, they made 1,023. They made 1,023,932,000. Of that, they retained 127,663,000. That was a 12.47% profit margin. Now, if we move down to the balance sheet, instead of reading everything directly from the balance sheet, we're going to look at the return on equity and debt to equity. Their return on equity. For return on equity, we love to see anything above 20%. We like to see anything above 10%. Um, Under 10% can be okay, but we'd preferably like 10% or above 10%. In 2020, their return on equity was 7.38%. 2021, it was 2.31%. 2022, it was 6.97%. But in 2023, it jumped 14.97%, above that 10% that I spoke about. And in 2024, 19.87%. Now, the debt to equity, we like the debt to equity to be below 200%. In 2020, it was 87.1%. 2021, 80.75%. 2022, 58.32%. 2023, 44.91%. And 2024, 75.74%. So for all 5 years, it was actually below 100%. And we said that we like it when it's below 200%, which means that we have a pretty decent balance sheet. We like the current assets to exceed the current liabilities, and we see that the current assets more than double the liabilities for all 5 years. Well, yeah, we could say double for 5 years. And the total assets pretty much double double or more the total liabilities for all 5 years. So they have a great balance sheet. I like their balance sheet. They don't pay a dividend, but I'm coming upon my first red flag here. As investors, we like to see when a company is buying back more shares of their stock and they're not constantly selling more shares of their stock. If they're selling more shares of their stock all the time, then they're basically using their stock like an ATM machine. But if they're buying back more shares of their stock, think of it sort of like there's 8 of us in an apartment hanging out, maybe having a party. We order a pizza pie with 8 slices. Everybody gets a slice. Well, if 8 people show up in that apartment and we want everybody to get pizza, now we have to cut every slice into 2 slices. So everybody's pizza is smaller. That's what happens when a company is issuing more shares of stock. On the other hand, if there's 8 of us and 4 leave before the pizza comes, now everybody gets to take 2 shares. That's what happens when a company is buying back more shares of their stock. So we like when companies buy back, not when they continue selling. Well, this company, they bought back $7,904,000 worth of shares in 2020, and they sold 1,488,000 worth. So they bought back more than they sold. We like that. But in 2021, they sold $1,503,000 worth. 2022, they sold $1,677,000 worth. 2023, they sold $8,053,000 worth. And 2024, they sold $5,561,000 worth. So that's the one red flag that I'm seeing with this company so far is the selling more shares every year. Other than that, everything is okay. Um, Free cash flow, they are getting free cash flow every year. I'm not going to read off the amounts because I primarily look at free cash flow when a company pays a dividend because the free cash flow will let you know if the company has enough money to pay that dividend they're paying. In this case, nothing is negative and they're not paying a dividend, so I'm going to bypass that. Now, this company, and these figures are coming from Yahoo Finance, this company has 2.54% insider investors. And insiders are those who work for or belong to the company. 2.54 is a pretty large number compared to a lot of companies. A lot of companies' insider investors is under 1%. Because notice that's 2.54% of their outstanding shares, which are 56,331,000. So inside investors own that 2% of 56,331,000 shares. Institutional investors, large banks and institutions. I don't know how Yahoo gets up to these numbers, but they have 109.21%. I don't know how they get above 100%, but what I do know is that means that the institutions are showing a lot of interest in this company, and that means they could be buying the price up because what drives prices up in stocks is when more people are buying than selling, and what drives them down is when more people are selling than buying. In any event, Mr. Turang P. Amin, born 1965, is the chairman, CEO, and president. Turang Amin has been the chairman and chief executive officer of e.l.f. Beauty since 2014. And e.l.f. Beauty is in the household and personal products industry, consumer defensive sector. So that's our stock analysis for e.l.f. Beauty, guys. I look forward to seeing you in the next video. Have a great night.